Two people retire with the exact same $2 million. They withdraw the same 80,000 a year. They earn the exact same 5% average return. 20 years later, one has $2.4 million, the other has 850,000 and is nearly broke. Same money, same spending, same average. The only difference was the order the returns arrived in. Here is why that decides everything. Before we begin, the disclaimer. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell anything. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them. Today, a concept that can decide whether your money lasts a lifetime or runs out early, and almost every retirement calculator quietly ignores it. Sequence of returns risk. Two people retire with exactly the same $2 million. They both withdraw $80,000 a year. Over the next 20 years, they both earn the same 5% average return. Identical start, identical spending, identical average. The math says they should end up in the same place. They do not. One finishes with around $2.4 million. The other finishes more than $1.5 million poorer, dangerously close to running out. The only difference between them was the order in which those returns arrived. We are taught to focus on the average return. Earn 7% a year on average, and the plan works, right? But an average is a summary that hides the journey. The same average can be reached by a smooth, steady climb or by a terrifying crash followed by a violent recovery. While you are simply holding and not touching the money, those two paths end in the same place. The moment you start adding or withdrawing money, they do not. The order suddenly matters enormously. Here is the part that surprises people. During your working and saving years, sequence risk barely matters and can even help you. If the market crashes while you're still contributing, your regular contributions simply buy more shares at lower prices. A 30% drop at age 35 is mostly noise by age 55. When you are adding money, a downturn is a discount. This is why dollar cost averaging feels so comfortable in the accumulation phase. Now flip it. In retirement, you are no longer buying, you are selling shares to fund your life. If the market falls early in your retirement and you must sell shares to cover your spending, those shares are gone forever. They cannot participate in the recovery when it finally comes. You have locked in the loss permanently. So a crash in your first few years of withdrawals does far more damage than the exact same crash 10 or 15 years later. There is a clean way to feel this. While you are accumulating, a loss followed by a gain and a gain followed by a loss end in basically the same place because no money is leaving. But once withdrawals begin, early losses compound against you in a way later gains simply cannot undo. The withdrawal turns a temporary paper loss into a permanent realized one. Same returns, opposite outcomes, purely because of when the cash is moving out. Let us go back to those two retirees and look at the gap in dollars. Same 2 million start, same 80,000 a year withdrawn, same 5% average over 20 years. The one who happened to get good returns early ends with roughly $2.4 million comfortable. The one who hit a bad market in the first few years ends more than $1.5 million behind, on the edge of running out. That entire difference came from sequence alone. Research drives this home. Studies estimate that roughly 77% of a retiree's final outcome is explained by the returns of just the first 10 years, not the full 30, the first 10. Planners call the danger window the retirement risk zone, the 5 years before and the 5 years after you stop working. What happens to the market in that single decade matters more than everything that follows it combined. This is why simple retirement calculators can be quietly dangerous. You type in an expected return, say 7%, and it draws a smooth rising line to a happy number, but that smooth line silently assumes the returns arrive in perfect average order, which almost never happens in real life. Real markets are lumpy. A calculator that only asks for an average return is hiding the single biggest risk to your plan behind a tidy straight line. Right. So, how do thoughtful people defend against something they cannot predict? A few honest, well established ideas. One, hold a cash or bond buffer, often a couple of years of spending, so you can avoid selling stocks during an early crash. Two, stay flexible with spending, trimming withdrawals in bad years instead of selling more shares. Three, shift toward a more defensive mix as you enter that risk zone around retirement. None of these predict the market. They simply make sure an early downturn cannot force you to sell at the worst possible moment. And here is the empowering flip side if you are still building wealth. Because early losses help you while you are buying, a brutal bear market in your 20s or 30s is, counterintuitively, one of the best things that can happen to a disciplined saver. You are buying years of cheap shares. The investors who panic and stop buying during those crashes throw away their single biggest advantage. Sequence risk is a retirement threat, but sequence opportunity is an accumulation gift. To wrap up, the average return is only half the story. Once money is flowing in or out, the order of returns takes over. While saving, early crashes help you. While withdrawing, early crashes can permanently cripple you. And the first decade of retirement decides most of the outcome. Build a buffer, stay flexible, and never trust a plan that only knows your average. None of this is a recommendation about any specific strategy. That is for you to research. If this changed how you think about averages, consider subscribing and, as always, protect your downside first. Thanks for watching. And if this changed how you look at your own plan, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone who is within 10 years of retiring because this is the decade that decides it. And subscribe so we can keep going deep together. Every week we do the digging so you do not have to guess. See you in the next one.